for me, inflation is a byproduct of an increase in money supply. Australian money supply is currently growing at about 9.1%.
You have the highest inflation in the developed world. If interest rates go up, our housing market is already massively overextended. Does that take the air out of the balloon?
The policy on this housing affordability, and particularly first home buyers, is absolutely reprehensible. It's the dumbest policy. The challenge with the reduction in deposit that's been required is that it exposes you to a significantly bigger mortgage, about an additional $225,000 of mortgage payments you will pay.
What about migration? How does that factor into inflation?
We have a falling level of productivity from our workforce. The government have talked extensively about the job growth that they've created, of which 75-80% are public sector jobs. It's a very, very dangerous situation. It's probably one of the bigger causes of a drop in living standards for most Australians.
What about the banks? That is the second third of our stock market. So inflation moderates, interest rates come down, which means we're trying to stimulate maybe an economy that's not operating as fast as it should be. Is that so good for the banks?
Falling interest rate, smaller margin, less profitability in the first instance, and then 2026, a year of opportunity or a year of traps for investors to fall into? In this conversation, Mitch and I are going to explore the two biggest risks that we see for the Australian economy. And no, it's not interest rates. It's something more sinister than that, which hopefully we can see get under control. If that happens, boom times for the lucky country. Let's listen, let's hear. But most importantly, let's make sure we take action. See you in the show. Hey guys, welcome to this week's Money and Investing Show with me, your host, Andrew Baxter, and always my offsider and co-host, Mitchell Olarenshaw.
Can't wait to be here, Mr. B. Looking very dapper today, by the way, in the green.
Likewise, blue.
Yep, green and blue will always be true, right?
Oh, was it blue and green, never to be seen?
Very nice. That's a great segue into almost the opposite of what we covered last week. We just recently did our US economic outlook, and that was the green. Let's get to the blue now. Let's talk about the Australian outlook for 2026.
Yeah, I would probably almost go red rather than blue, but there we go.
Personal choice.
Tricky one, isn't it? And, this is, again, time of recording, we're coming in towards the back end of 25, so there could be some nuanced changes within the economy as we see the back end of the year come onto us. But very, very important to have a game plan for the year ahead. It finds people flat-footed when you're in that sort of reaction type mode. You want to be responding to what your view is and really adjusting that. So the 25, interesting year for the Aussie economy and the Aussie stock market, barring the sell-off that we saw in November. I think we're up about 10 or 11%, which on the surface sounds okay, but when you compare that to what was on offer further afield, such as the US, it's a pretty anemic return for Australian investors in the local economy.
Year to date, as I say, you factor in that sell-off, we're only up about 3 or 4% here in Australia. So it's definitely been a little slower. There's really only been a couple of sectors and a few stocks within those sectors that have done okay. Everything else, for the most part, here in Australia, stock market-wise, has been pretty lackluster.
So why is that? Where's the outlook? What are we doing? And what are the sectors and stocks that we like? And what are going to be the drivers? So, the big things, I think, that dominated the headlines, and they're going to continue to dominate our outlook. Obviously, inflation, interest rates, and some of the key risks within the Australian economy, which are migration and property, amongst other things, are going to be worth a talk. So
I think as well, it's important to note, we compare the Australia to the US. The US has so much going on, growth, different areas and sectors. Here in Australia, we're pretty limited. So really, 2/3 of our market, our stock market at least, is made up out of resource stocks and financial stocks. Funnily enough, though, those stocks in 2025 have done pretty well. If you look at the likes of ANZ, NAB, CBA maybe lesser to a degree, had a pretty bad sell-off later on this year. Actually did pretty well. Fortescue, BHP, also not too bad either. So those stocks, the mainstays, have actually done pretty well this year.
They've been all right, but the biggest challenge for Australia as an economy is it's a very narrow, monopolistic type economy. We've got four banks, a couple of resources companies, 2 supermarkets, 1.5 airliners, 2 insurance companies. So it's a very, very narrow economy, which unfortunately isn't great for our consumer, which we've seen, and given some of the government policy putting further constraints and pressures on things is causing additional drama, which is very, very different from the US. Now, of course, yeah, we still have a tech sector. There are stocks like, Altesian, and you've got WiseTech and a few others that are sort of sitting in there. But they're a very, very small proportion of what we have. And the growth that we see in the US, driven specifically in that technology sector, it's harder to see for us here. But we'll go through it and we'll have a bit of a gauge on where we see some of the opportunity and risk across the different
Just
parts.
as important, a lot of our clients love trading the Australian market. Yes, it may be smaller in size, but it's very familiar. These are
Size isn't everything, Mitch, as I'm sure you've been told.
Absolutely right. It's not the size of the wand, it's the magic in it. So maybe we could talk to that here in Australia. Let's start off with inflation, shall we? So let's make the assumption that inflation starts to pick up here in Australia. What would be the primary catalyst for that?
All right. Well, let's firstly talk about what inflation is. So, people often look at inflation as CPI, the Consumer Price Index, and how much prices moved up. Yeah, and we're told, inflation in Australia is 2.83%, somewhere in that sort of range, which is in line with the Reserve Bank's target. I'd like to take a slightly different route on this. When we talk about inflation, for me, inflation is a byproduct of an increase in money supply. So if you increase money supply into an economy, print more money, and you've got more money chasing what is really a finite amount of goods, that's where you start to then get inflationary pressure, especially when you've got a very narrow monopolistic type economy. So Australian money supply is currently growing at about 9.1%. So for me, if you're someone that's holding cash at the bank, right, unless your cash is earning 9.1%, your buying capacity with that money next year is 9.1% less, because there's more money buying out there that's chasing the same amount of goods.
We have the highest inflation in the developed world, real inflation I'm talking about.
And it's across the board. I mean, anecdotally, as I say, you can look at CPI, which is very narrow, and this is why in the US, the PCE is a better measure.
Much better.
Than CPI. We don't seem to have taken that approach here. If I think about the communication with my utilities providers, so my electric bill, they said next bill, it'll be the price will go up by 9%, my water company, 8%. So this is the reality of the bite. Think about filling fuel up in your car, and we've talked extensively, oil as a commodity has come off from around about $85 a barrel to about $65 roughly a barrel as we speak today, which incidentally is where it was 3 years ago. Yet we're still paying, certainly where I live, over $2 a litre for fuel, which is ridiculous. It should be $1.60.
Yeah, I'd hate to know how much it costs to fill up your car too, by the way.
Big tank, and it empties very, very quickly.
Yep.
But yeah, it's crazy when you look at that, and that's another problem that we have. And we'll talk about Australia's energy crisis, I think would be the term to really use for that as we go on through. And this is by no means meant to be doom and gloom. This is the reality of the world that we're in. And if you dial into this and go, okay, so if inflation isn't 3% and is actually 9%, I do need to do something with my investing, because if my money is not growing at a sufficiently high rate, I'm going backward.
That's it. Okay, inflation goes up, let's say, or inflation is what it is. Interest rates then have to go up as a result to control that inflation. What do we then see in our economy this year?
Yeah, I think that puts a real chokehold on many, many things. So, the Reserve Bank under Michelle Bullock, we've had some rate cuts, and then we started to see inflation rear its head again. And I did a media interview just a week or so ago where we talked about, I think the Reserve Bank got it wrong on the way up, and they're getting it wrong on the way down as well. I think they've gone too quickly, and the embers of inflation were still there, glowing, and then a little bit of fuel, and she's up raging again. And I think we've seen that
pretty well too. Middle of 2025. I remember you saying specifically on a podcast, and our listeners will be able to verify this, we won't get any more rate cuts for the rest of the year, and you're pretty much spot on. We haven't really had anything.
It would be a very, very dangerous thing to do. And look, there are a lot of participants in the market that want to see that. Obviously, if you have a mortgage, and when we talk about a mortgage, I think we've got to be very clear. There's a difference between having an investment property where you can potentially pass on that higher interest rate to your tenants and or get tax benefit, or your primary place of residence. And a lot of people have really been struggling to make ends meet because, yes, our grocery prices and the general cost of living has gone through the roof, and mortgage payments have been relatively chunky. It's important to acknowledge that interest rates are actually relatively low on historical standards for us here in Australia. I think, when I first moved, it was something like 6.5%, 7% were interest rates. Now, with the three there, they're relatively cheap. The challenge is people have borrowed much more particularly to get into an overly inflated property market. So it's a real challenge. And I think if we see interest rates stay at this level, or worse still, we see a pop up, that's going to be a very crushing blow psychologically and financially for a lot of Australian households, which is terrible.
It's interesting, isn't it? I think about 1/3 of the housing market is made up of people who have a mortgage, where it's their principal place of residence. As you say, they're probably going to be the most affected, right? Because they have to service the debt. Money's got to come from somewhere. The other third is an investment property with a mortgage, and the other third is people who own their properties outright. If interest rates go up, our housing market is already massively overextended. There's been policy shifts to allow cheaper deposits for first home buyers as well. I think it's 5% now is all it takes. We see interest rates go up. I mean, does that take the air out of the balloon?
The government, and I think it's Ronald Reagan, very famous quote, we're from the government, we're here to help. When you hear that, run for the hills. The policy on this housing affordability, and particularly first home buyers, is absolutely reprehensible. It's the dumbest policy. It's a bending of the knee to a section of the electorate. It's as simple as that. Why? Why am I so emphatic on that? I'm all about young people being able to get into the property market. We talk about that virtually every week when there's a conversation around property. I want to see people do that. The challenge with the reduction in deposit that's been required is that it exposes you to a significantly bigger mortgage. If you look at the numbers, on average, about an additional $225,000 of mortgage payments you will pay if you come in with a smaller deposit over the lifetime of your loan.
That costs you a lot of money.
And the meat on the bone to where a slowdown or even a pullback in the property market is non-existent. And again, okay, how do you manage the risk? Well, you have lenders' mortgage insurance. Oh, no, we don't have that anymore. We'll push that off onto the taxpayer too. It's just sheer lunacy, politically driven, and apologies if that ruffles feathers. The truth will set you free. There is no strong economic reason for that. For a property market to work, we need to increase supply. That's the issue. It's supply side. And so, a move up in interest rates would be extremely painful for anyone that's really geared up on the back of, for example, the new first home buyers.
What about businesses? I mean, we talk about businesses and banks maybe in the same conversation, particularly the likes of, say, NAB, Business Bank. What's your view there?
Look, high rates, obviously, it gives banks a traditionally thicker margin for profitability. And let's be fair, our banks are very good at making a profit under most circumstances. And, to a large extent, our banking sector has been described as one of the best in the world. Quite what the criteria for that is, I'm not so sure, but they've certainly been very, very strong performers.
It's about 5 basis points. Their margin increases for every 25 basis points that interest rates go higher.
So that's pure bottom line profit, basically. And that's healthy because there's a very strong likelihood that, you've had bad debts to then start to cover. But rising interest rates is not always good for the business community, because if you've got business borrowings to try and expand, you're less likely to want to do that. If you look at the construction sector and financing within that, multiple construction companies have gone bust because the input costs of labor and raw materials have been through the roof. An increase in the cost of the finance is another thing that can really, I guess, cut you off at the knees if you're in the construction space. And businesses also have got other government legislation to have to contend with going into the new year too, whereby payday superannuation contributions is likely, and I happen to think that that's actually not a bad thing. Being able to be on top of it, because when you see companies go into administration and they owe their employees superannuation, it's terrible. They've worked, they deserve their super contribution. So that aspect of it is good. What it's very likely to do, though, is to cause cash flow issues within a lot of businesses. And if rates are higher to get finance to help maybe get through that, it does. I suspect you might see a few insolvencies fall out of that. That's what it's see. Banks, I think it's going to be good for them from a profitability perspective, as most scenarios typically are. And we might continue to see that sort of shining beacon within our stock market, which of course are our big four.
So a little bit left to field on this conversation though, AB. Still, what about migration? How does that factor into inflation?
Look, again,
sorry to put you on the spot here.
Migration is and I say this as a migrant to this country. I'm first generation Australian. I'm very proud of that, and I'm very proud that I made the decision to leave my country of birth, which was the UK, to come here for what I was hoping would be a better life, and has certainly proven to be a better life. The challenge that we have with migration is that right now there are two aspects to this point. Number one, we have a falling level of productivity from our workforce, and there are a couple of reasons for this, and I will come back. This is not the weave. I will come back and pull me up on this if we don't get there.
Okay.
the government have talked extensively about the job growth that they've created, of which 75-80% are public sector jobs. So they're not job creations. That is a cost on the ledger because the taxpayer's got to fund it. We've also seen falling productivity amongst our workforce. So just to give you one anecdotal example of this, 5 years ago it took about 9 months to build a house. Now it takes 14 months. So we are getting less productive as a workforce. With migration being added into that, one of the biggest challenges is that most people that come in as migrants are underemployed. And I couldn't tell you within 100 the number of Uber rides I've had where the Uber driver has been a first-generation Australian that's come in for reason A and was previously employed at a reasonable level. Let's say it's an engineer or someone that had
skilled migrant, right?
A skilled migrant with a professional qualification. But they're not able to gain work in that lane, so they're driving an Uber. So that is a real strong example of a fall in productivity where you're underemploying people. So why you would have a policy of we need more people coming into the country when you're underemploying the people that are already here, whether that's people that are first generation Australians or people that have been here for longer than that, is a real challenge. Secondly, if you have strong migration, where are those people going to live? And we've had, we're going to build more houses. Well, so far that's fallen flat. One of our podcasts, I think it was this year or the year before, I can't remember now, they sort of blur into one when you get sort of season 6 to season 7.
That's right.
Was the housing affordability scheme. And so far, I think there's a couple of hundred houses, if that, and I think they've been bought rather than built. Where are these people going to live? So you've got this enormous demand for places to live, whether that's in the renting pool, which has seen rents go up and price people out of the market, or whether it's people buying into the market with a very, very finite amount of supply where we're just simply getting left further and further behind with what we need. That is a major, major issue within our economy. And if you look at CPI, rent doesn't really kick in as part of the CPI calculation. Yet when you look at the proportion of rent or worse, mortgage payments that people are having to find out of their salary, it's astronomical. In some instances in Sydney, it's like 40-50% of your income is going in rent.
Yep.
It's just not a tenable situation. So there are big problems on that side. Weave over. So migration, big problem.
Yep. And it's funny because we spoke about interest rates increasing and the kind of dire effect that could have on the housing market and the flow-on effect with all these other factors is nuts. And it just shows how reliant we are on housing here in Australia.
We are. And maybe that's the thing that's artificially keeping prices where we are, is that excessive demand coming from, I'm not going to pin it on migrants, but excessive demand for property in a market that does not have the supply to meet it is where you get prices moving higher. It isn't sustainable. It's a very, very dangerous situation. It's probably one of the bigger causes of a drop in living standards for most Australians. And it's very, very sad to see because we could, should, and need to build more houses.
Okay, let's look at the opposing example. Let's take the effect that inflation remains relatively contained. So prices either drop or they stay where they're at. And we see interest rates remain where they are or get cut, continue to get cut. What then happens? What would be the catalyst?
Look, I think the catalyst for that, you'd need to see a decent drop in inflation, which I don't think you're going to see based on the points we've just articulated. If you do see interest rate cuts, then you have a resumption of stronger consumer spending, which ultimately gives you inflationary problems down the line again.
Housing market gets pushed higher again.
Gets pushed higher again. You got retail sales driving higher. And for many households, some cuts in rates or repayments would probably give them an opportunity to come up for air because they have enormous mortgages based on paying way too much for an asset.
What about companies in the stock market? Because you would venture lower cost of borrowing should mean more money that they can then innovate and reinvest, right?
You'd like to see more capital expenditure, which is one of the things we've talked about extensively in the US. And you go, okay, if we had lower rates and more capex and get ourselves established as this technology leading country, the challenge we have behind all of that is actually our energy policy, which is, I don't even know if we do have an energy policy. It's kind of very, very hard to understand as one of the world's largest coal producers, one of the world's largest natural gas producers, one of the world's largest uranium exporters, why we have an energy issue in our country. And it was you know, the fallacy of it all. I just saw one of the wind farms that they're building in Tasmania at the moment has got asbestos all the way through it on the components it's importing from China.
Really?
So
asbestos?
Yeah.
I thought that was illegal many years ago, decades ago.
It's legal in the right way, but so we're trying to do one thing, we're getting the opposite, and yet we've got all these natural resources we're not using, and so we need to have a level of clarity within our energy policy to bring energy prices down. That's likely to be disinflationary. If we have an investing cycle which is building more stuff, it's going to require more energy to use. We have a finite energy problem in our country because we have to import the stuff that we use now. That becomes an inflationary challenge as businesses competing with households for energy.
So a question for you, whilst we're on the topic of commodities, we as an economy aren't super diversified, right? A large part of our economy is made up of the resource sector. Iron ore, gold, copper, for example, are our major exports. We have a massive reliance with China and the rest of the world on buying the stuff that we make. What do you think may happen with commodity prices, and how's that going to impact our companies here in Australia?
Look, we've relied on China as our largest trading partner for a very long time. I mean, effectively, it ensured that we sidestepped the GFC to all intents and purposes because that mining bonanza started just ahead of that. China's going through its own challenges. The economy is stalled. It's got deflationary problems. Its economy is still going to grow at around 5% a year, which compared to Europe, which is growing at 1%, US it's sort of 3 and a bit. It is pretty healthy growth, but the maturation of the Chinese economy of requiring such vast quantities of iron ore and coal, for example, to create steel in order to build is coming to an end. We've seen all the ghost cities and the issues with companies like Evergrande for overbuilding, all those different things that are there. So I think there's going to be a change in the dynamic in the resources sector, and what we've enjoyed on an iron ore led and coal led charge. And don't get me wrong, I think there'll be demand for both of those commodities still. The shift to rare earths, I think, is something that becomes increasingly important, and that move into sort of second tier is a very unfair way of describing businesses, but take something like Linus as an example that's in the rare earth space, becomes a really, really strong tailwind for companies that are in that resources space, but not BHP, Fortescue, and Rio. Some
and
of those
a good end to the 2025 Linus as well.
Yeah.
Been really strong.
So, just a change in the lens in resources. So it's still resources, but it's a little bit along the corridor in terms of some of the more niche places. BHP's had a great run out of its gold, for example, too, with gold prices running in the way that it has. So I think, slight shift in the resources action. Lithium and rare earths, I think, is probably where we're going to see more growth.
Okay, change your pace. What about the banks? I mean, that is the second third of our stock market, really. So inflation moderates, interest rates come down, which means we're trying to stimulate maybe an economy that's not operating as fast as it should be. Is that so good for the banks?
Falling interest rate, smaller margin, less profitability in the first instance. And then if you look at the sort of working parts, you mentioned earlier, NAB with its business banking. If you're cutting interest rates to stimulate your economy, your business transactions are probably slowing down. So that's less good for companies like NAB. If you've got interest rates being cut, also to try and stimulate an economy, it may be that your mortgage book is under some level of pressure where you might have, mortgage delinquencies increasing, repossessions possibly coming along. So technically, we all think, interest rates being low would be good.
Maybe in the short term, right?
But it's a poison chalice as to why are they being cut, and why can't we hold a sustained normalization of interest rates that are still half of what they were 20 years ago? Interesting. It's just the fact of the matter is we've got an economy that's driven so heavily by property that's so fully priced. That's not to say it's not going to go up any further, because not enough stock being built and still more people coming and more people needing them. But it's enabled us to have this incredible skew where all of a sudden, cutting interest rates isn't always a good thing.
Yeah, I'd really like to see some of these Australian stocks really diversify their business operations and get stuck into some of the more interesting areas of stock markets abroad, like AI and tech, which we just really don't. I mean, we've got some growth stocks, as you say, like WiseTech and a few others. It's not a massive part of our economy, and I'd really like to see it.
Well, CSL for years has been like the leader, and that's had an absolute belting through the back end of 25.
Yeah.
And it would be great to see what the next thing is. And look, just because you're associated with technology, and we talked a little bit about this in the US Outlook just previously, one of the biggest challenges that I saw through the dot-com boom and subsequent bust in 2000, 2001 was that companies could just come along and say, we're like that and we do a similar thing, and they're off to the races in terms of investor appetite. And I think one of the things that we're going to see going into 26 is that the bell is going to start ringing where companies that claim to be, oh, we're like that, we're doing a similar thing, will have to deliver on earnings. Now, of course, the big guys, we've seen, incredible earnings growth come out of the US leaders, 17, 18% earnings growth. NVIDIA just belted it out of the park again in terms of from an already massively high expectation. It's just aced it.
Clubbed it.
And for those companies that maybe aren't quite in that space where they've kind of got sucked in on the coattails, if you will, of that. And I'm thinking Drone Shield's a good example of that. So here's a great Aussie business that's in the defense contracting space using drones, which you would think, with the war in Ukraine and different things going on in the Middle East, it had an incredible run. And all of a sudden, boom,
20% down day.
It's just imploded on itself. And what's worse is that I think from a corporate governance perspective, you've got a board of directors that haven't come back to face the music. They're on a road trip at the moment, I presume raising money or trying to sell their product. Their in-house broker said, well, we need to have an earnings call and find out what's going on. It's like, we can't get to that just now. And when the news is bad, that's the time you need to be present to steady the ship. So that to me sort of smacks a little bit of a momentum that's not quite as legitimate as that which we're seeing in the big guys that are really leading the chase. And again, just in a totally different sector. If you think about, say, Guzman Gomez, which was one of the better IPOs that we saw, and Guzman y Gomez, if you haven't tried their product, it's Mexican with a twist. It's convenient. It's easy. The food's pretty reasonable. It's slightly healthier than most junk food that you're going to get.
It's a good Friday feed at the office.
There you go. Good job I don't work Fridays. Otherwise I'd be here filling my boots with my
12 o'clock every Friday. You know where to find us.
The challenge they had, they had a ripper IPO that was massively oversubscribed. Everyone wanted a piece of the action, and they raised the money to go and expand in the US. And the share price has imploded. It's back to its IPO level. And I think so far with the millions they raised, they've opened maybe 2, if not 3 stores in the US. And the whole mandate behind it is, okay, we need this to expand. And the US is the big market that we've got to be there. But if you step back and think, well, hang on a minute, you're an Australian company and you want to sell Mexican food in America, which has lots of places you can already buy Mexican food in an extremely competitive sector. It's
like
only wonder that you've been absolutely flogged and your shareholders are lost on the back of it. So I think to sort of shift this into more of an outlook, I suppose, for our listeners, that emphasis on quality and reality becomes extremely important. And banks have that in spades. Our resources companies are legitimate in what they do. We've got rare earths exposure that's there too. If we see a slowdown in the economy and if we see interest rates not get cut further, I think some of our consumer service type businesses and consumer discretionary will continue to feel pain. We've seen, I think, an unprecedented level of pain across, for example, the garment and clothing industry in Australia. Think about how many brands have been lost off the high street or gone into administration, high and low end, things like Tiger Lily and at the other end, Nonny B and companies like that. So both ends of the spectrum have been hit pretty hard, which is a reflection on the changing tempo, I suppose, within the economy. People don't want to go to an average mall and buy average clothes. They want to go online and have a global experience. And we just don't seem to have the alignment there. And I think we need to, and that's one area I'd probably be fairly careful with going into the new year, is that consumer discretionary type area if we don't see further rate cuts.
Interesting. All will be revealed as time goes on. It's always funny when we sit down and have these conversations, isn't it? Because we've got all of the available information, we've got the expertise to back it up, but still we can have those surprises that always pop up.
It's going to be dogleg, It's if this happens, that could happen. If this happens, that happens.
Yeah.
And I love, if I go back to my time reading economics at uni, is like assuming ceteris paribus, assuming all things remain equal, which is like assuming you can't be wrong. This is what I do. It's just ridiculous assumption, isn't it? But that said, if if you look on the other side of the coin of what we have going for us here in Australia, we are still the blessed country. We're the lucky country for sure. And, noting that, the US, for example, is having issues with its beef industry, which I hope is good for our farmers. I know we've got a great many farmers amongst our listening community, and hopefully, that export of beef to the US is something that we can see help reboost our agricultural sector. We are a great country, and I think if we play to our strengths of harvesting and utilizing our energy rather than just simply exporting it, we'd probably be in a significantly better position where that lower energy cost makes things significantly more affordable for people. But when you've got that millstone around your neck of $2 plus a litre for your fuel, your household electric bills through the roof, and everything is expensive when energy is expensive, it's very, very hard. Big review of our energy policy would go a long way to helping us, and I think give us a much, much stronger outlook going forward, not just for next year, but for our kids and beyond that.
Well said, AB. Thank you very much for today.
My pleasure, anytime. There you have it, guys. Make sure you like, comment, subscribe. Most importantly, hit the notification button. We'll look forward to seeing you next week.